Welcome to the Stewart Squared podcast. Today we are going to do a deep dive into the money, the financial business foundations of how to think about investing huge amounts of CapEx, including $392 billion in 2025 alone, matched against depreciation of $40 billion a year. But that's what I want to ask you later, is what is depreciation? Why does it matter? Versus $20 billion in revenue. And this is all of them together, all the foundational labs, that's all they spent. Is this something that is sustainable?
So you mentioned why you were saying we'll talk about that later, but for some reason my Limitless app came up. Let's go away. So let's start with depreciation and understand what it is, because that's kind of the basis for what the question you're asking. Simple accounting, if you're a sole proprietor and person, what money you spend has to be put against whatever income you have. So income and outgo, that's very simple. Cash, it's called cash accounting. Ironically, the U.S. government is on cash accounting. So every time they buy a $3 billion aircraft carrier, that's outgo. They don't account for how long that thing will last. And that's where the concept of depreciation comes in, is in business accounting, double entry accounting and GAAP accounting. The idea is to account for how the benefit of that expenditure over time for buying something that lasts. So there's various schedules of depreciation for different kinds of things that you buy. A car normally depreciates over maybe a year, actually, because as soon as you buy a car, it's worth less. A house depreciates over, you don't really buy houses as a business, but a building depreciates over 20 years, maybe. So whatever, there's a schedule of depreciation for different classes of things. And so the debate in the AI world is, how long will this investment in Nvidia chips and server farms be valuable? And AI is moving so fast, including the generations of Nvidia chips, and so you pack those into a server farm, like they're doing down in Texas. Well, I mean, a bunch of them all over the place. But the value of those Nvidia chips declines over time because there's a next generation, and then there's competitors. And so to build foundational models, the value of a chip and its implementation in a server farm might not be worth depreciating over a very long period of time. It's a judgment call, right? I know, because we don't really know where all this is headed. But normally, chip factories and server farms depreciate over a fairly long period of time because there's a perception that the value is persistent over it. So pick a number, say 10 years. And that's the debate, right? So if they're spending, what'd you say, $20 billion? Well, you said a much larger number.
Yeah, I said $392 billion this year in 2025. I think that expands for the whole year. $40 billion for the depreciation of this year alone and going out into the future. And I want to ask, like, $40 billion each year. How? I guess the question now I know how to ask is, what is the depreciation schedule for that $40 billion? How long in the future? And then $20 billion.
It would imply, if you spend $400 billion and depreciate it over 10 years, you'd be taken against your income statement. You'd be taking $40 billion a year.
That's 10 years.
Of course, that's not a collective income statement. That's per business. So there's differences for each company.
Yep.
It a little bit goes back to where we were talking about Microsoft saying that, they're not going to spend that much money. They already spend a lot of money anyway because they have an enterprise business and Azure and all of their infrastructure business. They were already spending billions a year building out their capacity. And then AI came along and they started spending more.
Yeah.
But they did actually have the advantage initially of OpenAI was spending the money for them to some degree. They also have, when you implement AI, you have to have an infrastructure that allows your tokens to be responsive, basically. So they were increasing their spending, and Satya Nadella and the team were sitting there looking at that and going, maybe this isn't sustainable on this basis. And so they slowed it down. They did what they needed to do, but they weren't spending wildly like OpenAI and Anthropic and all the others. So
Wow.
it's an open question, right? Now, when you asked me about this earlier, I said, well, this is just like we had this conversation too, back in 1999, when the telcos and other companies were digging trenches and putting fiber in the ground in order to enable broadband internet, which at the time was, like a 10th or 20th of what we experience now. The idea was, that would pay off, but it didn't, because then the crash happened. And every owner that had been digging trenches and putting fiber in it didn't go out of business, but they lost that business. So if they had another business to sustain them, they stuck around. But and those assets were then sold for cheap to others, and others have profited from that because, as the vision called for, we now have broadband internet, and a lot of it goes through fiber. Starlink and other stuff is new and unanticipated. And so same thing's going to happen. And one might posit that Microsoft probably has the resources to survive whatever happens, good or bad. What's really called into question is Meta's health, because they have this business, Facebook et al., social media, that just throws off billions of dollars of cash, and they're spending it, and they're spending it for two things, which is where maybe it calls into question. It's like fighting a war on two fronts. You got the enemy in the back and the enemy in the front. It gets to be kind of a drag. You have to spend the money to do both things at once, and that's kind of what they're doing. They're have been spending tens of billions of dollars doing hardware development for whatever it is, VR, AR. And then they're also now spending tens of billions of dollars. So, and not very successfully in the AI business. So, can Meta sustain that? What if Facebook goes down just a little bit? And social media doesn't produce as much cash, which of course AI is the effect.
Yeah.
So this is a very complex multivariate problem to try to figure out how it's all going to work out. And you got a lot of players, like Meta's a player. Well, right now it looks like they're actually just blowing money to try to stay a player.
Yeah.
Microsoft is a player, OpenAI is a player, Anthropic is a player, Perplexity is a player. So you got all these players, and anybody that doesn't kind of keep up ain't a player anymore. The whole point is to be a player, and there's no measurement of, how much money you need to spend or anything else about what keeps you a player.
So, okay, I got some numbers here because I asked what is Meta's CapEx for 2025 so far. As of Q2 2025, ending June 30th, 2025, total capital is $31 billion. And that, so that's the interesting number, but it didn't split it up into categories, which is what I wanted. And so.
Well, you can ask the GPT. So how much of that was hardware and how much was AI server?
Yeah. Versus server. And it gave me a little bit of that, but I just asked that. So it gave me CapEx Q2 2025, approximately $17 billion, driven primarily by servers, data centers, and network infrastructure, and supporting AI infrastructure. And that's a key thing because Facebook happened before the rise of the cloud. So they have always built their own servers, which is probably a really big asset for them.
Actually, probably not, given what it is, but that's a whole separate conversation.
Okay. And then before we get to the actual categories of the hardware and everything, there's the how much did they do in acquisitions? So they bought Scale for $14.3 billion, or they bought 49% of Scale. They bought Play AI. They bought these smaller ones. Luxottica equity investment. They got the 3% stake they made an equity investment of 3% stake for 3.5 billion in Essilor Lux. Can't even pronounce it. Some shady stuff going on there if I can't pronounce it.
No, that's not shady at all. Those are the glass company, Ray-Ban.
Oh,
They own all those glasses brands. And there's another one too, but they were the ones that kind of figured that out. They bought Ray-Ban. They bought, what's the sporty one that Facebook Meta has announced for another set of glasses. Anyway,
don't worry about it. Let's go.
Essilor owns like 15 different brands of
Got
eyewear.
it. Okay. Oh, interesting. So they're doing the private. So
that's just a strategic. It's called a strategic investment to give them a stake in the company.
Okay, and then but Meta, in addition to actually doing a semi-acqui-hire to avoid DOJ interest, Meta initiated billion-dollar scale hiring spree for AI superintelligence. And so they offered
they initiated that, but that's not recorded in Q2.
Yeah, okay. So that's extra, and they offered an individual AI researcher 1.5 billion.
That wouldn't be a capital expenditure.
That's not
most
a
of it.
CapEx. Interesting.
Yeah, and in fact, equity investments are not considered a capital expenditure, right? You're buying stock in another company. The payoff is how that company does. It's not a matter of whether you have to keep it for 10 years or 2 years or whatever. There's no time base to that. So CapEx, capital expenditures, are buying things that are not written off in the same year, that are not your expenses in the same year.
For tech companies, that's wildly different, I guess. It's the same thing as railroads, probably, right? Railroads, telecoms.
Well, I mean, it depends. Even the hardware business is software business. Software has no CapEx in theory. I mean, that's a hard. If you're making software, there's no CapEx.
Okay.
I mean, even go back to Facebook. Facebook did build its own infrastructure because the core technology for Facebook was the newsfeed. And the newsfeed meant that they had to have a real-time infrastructure so that any post on any one newsfeed would update in all of the other newsfeeds that it should, not all of them, just the ones that, were connected, your friends or followers or whatever. And that was a very difficult technology. And the server infrastructure previously didn't serve up that kind of transaction that fast. So they built their own infrastructure. And that was what made them, when you did a Facebook post, it would show up on everybody else's within microseconds, right? And no matter where they were in the world or, what kind of connection they had. That was a very hard technology problem. That was the one that when they were talking about move fast and break things, that's what they were doing. So they were figuring out how to do that before they had it kind of normalized.
Okay. So that gives a really good question that leads into our thesis for the show is what were the precedents before that? Because I'm sure people tried to do real-time stuff. Didn't just happen in a vacuum. Where did it start? When did people think like, okay, we got this internet, 1993, 1994. How do we make it real-time?
It wasn't how do we make it real time. It's what is it that we're doing that requires real time. So I mean, going all the way back, Google was doing search, and before they figured out how to chart for it, the whole game was how fast is the search response. Right? You put in your thing, and what would blow people's minds? They put in their thing, and they go, bang, like that. You go, wow, that was not possible before. So it blew people's minds. That's why Google became a hot company. And that was not real time per se, because there was a gap between when you ask it and the perception of how long it takes to get it back. So they optimized their infrastructure to deliver the result as fast as possible for any one search. And then they built a whole infrastructure around that, and that was their original infrastructure. Twitch, to be honest, or Justin TV, actually. These guys built a real-time infrastructure because when you started streaming, it had to start streaming right away. You couldn't wait for it. And so when you're sitting there watching in Twitch, in the case of Twitch, or there's other applications for Justin TV, but when you're sitting there watching it, you're watching somebody play a video game and you're chatting on the side. That all had to be a real-time infrastructure. There's no ability to distribute the load, was the word. Right, every individual watching that stream had to watch it at the same time as everybody else. So the source there was only one source, right? You couldn't, they kind of figured this out later, but you had to launch that video and it had to deliver to everybody in real time. That was a real-time infrastructure. And they built their own infrastructure as a result because Akamai and the edge computing people didn't solve the problem. And in fact, that's very relevant to the Cloudflare interview that I sent you.
Oh, yeah, and we need to talk about that as well because that's very related. But first, let's go into the history because this is important for the book that you'll eventually write, which is about that Justin TV. You saw that in process. So I'm going to go look up some things about Justin TV, the dates, important dates. But while I'm doing that, can you talk more about the characters involved? Who figured that out? Do you remember what were the characters involved and the challenges?
You mean at Twitch?
Yeah.
So there were 4 founders. One of those founders was Emmett Shear. He designed it. He figured this out. I remember talking to him about it. That's why I know about it. But so I don't know who the other engineers were that were working on that problem. But Emmett became CEO of Twitch. He was one of the 4 co-founders, and he was basically the chief technical officer for Justin TV. But he's the one that said to his other 3 founders, we should look at what's going on with the people watching video games on Justin TV. It was a very small piece of the traffic on Justin TV. But he was a hardcore game player himself. So he was experiencing watching other people play video games. And he's going like, maybe we should bet on this. And they figured it out. I remember the dinner we had at the Ritz-Carlton in San Francisco. And and it was me and the 4 founders. And they said, well, we've decided, they didn't ask my opinion on this, but we've decided that we're going to change the name of the company to Twitch. And we're going to focus on this one application. And that was the key moment. And Emmett proposed that and understood what the requirements were for it.
Whoa. So that seems important. So before that period, and I've got all my history here. So before that period, they were doing that technical innovation, but they probably weren't doing the technical innovation of having one source with many things. But they probably weren't doing it at scale. Is that inaccurate? No,
they were doing it at scale, but just for many different applications. So it was called live streaming. So whatever life you had would be what you were streaming. Young ladies showing off their form. There were video game players. There were live sports for sports you couldn't get elsewhere. Well, they were live sports for every kind of live sports. But and so there were, I think they identified, I may have the number wrong, 12 different applications of live streaming. And so in that, they were looking at all of them, right? And they built a generic infrastructure that would handle any of those. When Emmett said, look, what's going on with video game streaming, they had to build that particular application to be more effective because there's properties of video games, like high bandwidth video, real time. And so they had to optimize for that. So they'd already built an infrastructure for Justin TV, but when they started doing Twitch and it grew so fast, they built a different infrastructure. And what they would do was load all the content so they could distribute it. So you could have a live stream of a video game that would work the same. There's an inherent concept here. Let's see if I can remember the terminology, which is latency. So when something starts at what point in the internet, how long does it take to get to the endpoint? That's latency, and the inherent underlying latency in the internet at broadband speeds worldwide is something like 20 milliseconds or 60 milliseconds. I don't actually remember what the number is, but it takes time for it to travel. And then the other side of it is how long does it take for us to perceive that it's happened? Right? So when the stream is launched, how long does it take us to see the stream and to engage with it? And is there any latency in there, particularly if there are multiple streams going on? So this is real time, real time. There's a thing called near real time, which is more related to storage of files and in the cloud, but which is it's not actually happening in real time. Even real time is somewhat delayed by milliseconds, but it's not happening in real time.
Imperceptible.
It's
It's all about
nearly
being
real time.
perceptible.
You call for a file, and as far as you can tell, it's pretty fast, right? Because it's often a sideline storage, and the network has to bring it back and send it to you. And so there's different these are different applications in a high-speed internet.
So yeah, there's a lot there, and it's funny because we're having latency things here. So I can, but the cool thing is that Riverside's figured out all the latency, so it's not going to
So
affect.
I'll describe this for our listeners. You're seeing me in high resolution. I'm seeing me in high resolution, but I'm seeing Stewart III in low res because we have an interconnect. It's there's a term for it, but it's reducing the quality of the video to me, but it's recording at Stewart's source. And this is the thing about Riverside. It's recording the source of both, even though it's not showing them both to us.
Yes, and so I want to go back to the history. So we got 2007 is when Justin Kahn, Emmett Shear, Michael C. Bell, and Kyle Vogt. Kyle Vogt, I want to talk about that later because that turned into something else. But that's 2007, and then 2011 is when you probably had that demo, maybe a little bit before, the gaming section. They're like, okay, well, this is there's something here. And then by 2014, Twitch had grown so dominant that the company decided to shut down Justin TV entirely in August 2014. And then only 1 month later, Amazon acquired Twitch Interactive for almost 30 million shy of $1 billion.
$970 million to the shareholders.
Yeah.
It was actually over $1 billion, but the earnout for the executive team and employees was on top of that because that was future payout.
That's golden handcuffs.
Pretty golden too, and that's a whole other topic. But Amazon is very smart about how they acquire companies, and they applied it. And as a result, Emmett was CEO of Twitch for, I think it was 7 or 8 years after the acquisition, even though the normal buyouts kind of contemplate 4 or 5 years or less.
Wow. Okay. So that is just, we might have talked about this like 6 to 12 months ago. And if you're interested in those episodes, please go back into the library. But 2007 to 2011, what were you thinking during those time periods related to this investment?
So this is completely off the topic we've been on, but so we invested in Justin TV in 2007. We formed our firm in late 2006, so it was one of the first deals. Not the first, but one of the first. And the succeeding 4 years were very frustrating because for us collectively, us Twitch and Alsop Louis, because the company tried to raise more money and couldn't. Because Justin TV was like, what's the business and what's the future? It's like, you got this, you got that, and a little bit of Justin, a little bit of that. And, there was no obvious path to major business. So we doubled down. We put more money into the company. We put $3 million in the first investment and $5 million in the second, I think. I could be wrong about that, but so that's all on the record, I'm sure. It's in our records for sure. Can't remember whether we put more money in the first time or the second time. So whatever. Because they weren't able to raise money, we said, okay, we'll put more money in, but you have to figure out how to become profitable. Because we can't put any more money after that in, and you haven't gotten anybody else interested. So they started doing programmatic advertising against Justin TV. I called it programming for dollars. And they did. They became profitable. They generated enough revenue out of really cheap programmatic advertising, like pennies per 1,000 impressions. And but they had so much of it, they ended up bringing enough money and they made themselves profitable. So they weren't burning cash anymore, which gave them the opportunity to look at the business and understand it and kind of figure out what to do, which is when they came up with Twitch. And then as soon as they named the company Twitch and that application started taking off and Justin TV was kind of put to the side, which, for reference to back to what you were saying, Kyle Vogt ran Justin TV after Emmett became CEO and Twitch started focusing on video games. And but it was a declining business. And so as soon as Twitch it became Twitch, it's like people think it was a spin-out. It's actually the same company. They didn't spin anything out. They did spin social came out. That's a different issue. So as soon as it became Twitch and Twitch started growing like that, boom, Bessemer Venture Partners put in a Series B and set the valuation of the company much higher. And then there was a third Series C, and then they were bought. I mean, like the first 4 years was like, this, that, nothing was really happening. And then the second 4 years were like, boom, right off the top like that.
It's so crazy how it works. Like, it's just so crazy how it works. There's a lot of investment questions I want to ask, but I know we want to get to the Cloudflare stuff. But like, I got to ask the investment questions because it's you're in this early stage company. You like being before all the other investors. And this relates to something else I was reading that I wanted you to comment on for Newcomer. I don't know if you saw that email, but Newcomer was quoting Martin Casado, who we both saw Martin Casado and Eric Newcomer at Cerebral Valley in 2024, and basically Martin is like, nobody's a contrarian anymore because now Series A is basically like private equity. And that seed, yeah, there's still something in seed. There is still a differential in seed, but everything after that, they're all just follow-on investors. They're all just sheep, and nobody's a contrarian anymore. And so there's something interesting there. And it feels like in that 2007 to 2011, that is the period at which like everybody gave up. I bet nobody was looking at this company. But then as soon in professional investors, they keep their ears wide open to all this type of stuff, right? So they're just listening for they're like spies, right? They're waiting for the thing, and then immediately they put the money in. Is that how it works?
Yeah. The problem is that like Series A, B, C don't mean what they used to mean. So the terminology changes over time. And the entire venture capital business shifted from 2010 to 2020.
Yeah.
ZIRP time, like zero interest rate.
Yeah.
And then 2020 was like pandemic and all kinds of shit happened. But during that decade, how do you put money to work? Right? You don't put it in a bank because you're going to lose money, right? If you just store it in a savings account with 3% or 2% interest, which is long gone now. But so professionally, how do you put money to work? And everything except venture capital was looking kind of crappy. Right? Real estate, 2008 was the blow up on real estate, and so you could be really safe and put it in U.S. Treasury bonds, or you had to take a risk. And so the definition of risk changed during that decade. It may come back, but that's what happened then. And so it used to be that Series A was the first round of financing for a startup company. Now pre-seed. Now there's pre-seed, seed, Series A, B, etc. So now pre-seed is what used to be Series A. There was a period of time when seed what used to be. So whatever the earliest thing is has been renamed. So yeah, to some degree, when you're in formal series kind of financings, it's a little bit more like private equity, but you have to be careful because there's two kinds of private equity. There's growth equity and there's private equity. And growth equity is kind of like venture capital, but later on, where there's still risk. But there's a history for the company, so you know kind of what's going on, but you're not buying the whole company or substantially all the company. In private equity, that's what they do. They buy the whole company, and they buy other companies, and they put them together, or they fix them, and this is all very programmatic, and there's very little risk. In private equity, if you lose money on one deal, you screw your fund, right? In venture capital, if you make a lot of money in one deal, you're good. You can lose all the rest of them. And that classic, and I have talked about this before, is Kleiner Perkins 9, which invested in Google and 31 other companies, and they only made money in Google. But they made so much money, it didn't matter. It was one of the best funds ever known to mankind because Google succeeded so fast and so big. So, this is it. So you got seed, pre-seed. Anyway, so all the terms have changed.
Yeah.
And we did Series A. We probably should have called it Series Seed with Twitch, but we just formed our fund, and that was the way that we thought about it. Yeah, it was completely risky because the first 4 years sucked.
Yeah. But that doesn't matter, right? Because it's the 10-year frame, and
10-year frame, and we got 8 years and got the outcome.
Yeah. Okay.
So we got the outcome before the fund life finished.
Yeah. Before the deadline for whether it counts or not. Is that right?
Yeah, but there's always, because there are extensions and other things. Yeah, okay. So our second fund is in its 15th year and still hasn't returned capital.
Got it. Okay, so I want to talk about Cloudflare, and because we talked about the past, we got the past figured out, we've talked about investment and stuff like that. Now I want to turn the eyes to the future because we started with this with the CapEx, all these different things. We both listened to a great episode about agents that you sent me from the guy who was at Adept who got bought by Amazon. Now I understand why Amazon lured him into those golden handcuffs, which we can probably talk about as well. But they lured him in because they have compute. Not only do they have compute, but they have the best data set. Well, actually, this is a great question. I'm going to turn that into a question. Does Amazon have the best data set for RLGems? RLGems are a piece of jargon. The other really important jargon is universal verifiers that's related to RLGems. Universal verifiers were created by OpenAI. These are all ways to basically do supervised learning at scale type of thing, but for agents, because it actually gives the agent an ability to go take action. And so this is all going on at Amazon. So that question, which I've now forgotten, like, is Amazon best set up for the agent takeover?
So back off and talk agents.
Yeah.
But when you're talking about Cloudflare, it actually kind of forks, but we'll start with agents. When you talk about agents, you have to have some form of giving a piece of software your proxy so that it acts on your behalf. And when it's you, if it's you, a company, it's one thing, and it's you in person, it's another thing.
Yeah. Yep.
And there are two companies that are most focused on you as an individual. One is Apple, and the other is Amazon. Amazon, because it has a commercial relationship with you, right? It delivers packages to you, and its entire infrastructure is built around giving you what you want to buy, right? All the way back, that started as the hell is it called? Collective. It's memory. Back in the beginning, Amazon did something that was associating you with particular kinds of activity, which had been done in other domains, but they applied it to shopping, and in particular with books originally. And there was a term for that, and I forget what it is. Now you kind of roll forward 30 years, 25, 95, almost 30 years from when Amazon started. And they have this huge set of data about people's preferences, right? They know what you bought, what you buy repeatedly, what you buy once and never again, all this stuff, which is one domain of us. And I have some other data, and I've been doing Alexa for whatever it is, 7 or 8 years, which is pretty dumb, but not quite as dumb as Siri, but pretty dumb. So they want to use that data to deliver value to you, individual. And so for in their context, they've hired this guy, David something, Wayne, anyway. And this RLGems, I don't know where the RL comes from, but gems means
reinforcement learning. Reinforcement learning.
Yeah, reinforcement RLGems. And gems are a piece of data that informs the model what your preferences are. Right? So it's attached to you. And because the problem of responding to what you are I am
Yeah.
interested in is very specific to me, but might have hundreds or thousands of elements, each one of gem, right? So that gem wouldn't apply.
Mhm.
That gem might apply to other people, but then you are a collection of gems. I'm probably screwing it up. And the
No,
guy
I
from Amazon
get
isn't
it.
listening to
This
this,
is really
it's conceptually, you have to find a way to represent as data, right? Because everything defaults back to ones and zeros. That the collection of which defines who you are. That's agentic. So Amazon's a little further ahead, I think. This guy was one of the founders of OpenAI, if I remember correctly.
No. He worked at OpenAI in 2018, 2019. So he was one of that early crew
And
of
then he went to
OpenAI.
Google, and then he went to
No,
Amazon.
yeah, no. Then he started the company Adept.
Right.
He started the
Adept,
yeah.
He might have gone to Google before he started Adept, but anyway, he's got very serious balls here in the world of AI, but particular because he's now at Amazon. His focus is on making it agentic, and a lot of people are going, "Well, you got to do it through the browser," which is problematic because browsers are very loosely defined piece of software, and it's very hard to be precise. Whereas Amazon has built this huge infrastructure because, of course, it didn't spin out, but created AWS out of Amazon retail, which is designed around the end user. So at some level, they've gotten to the point where they are closer to the idea of an agentic agent that doesn't depend on a browser. Which is what Apple said they were doing, but realized too late that they weren't anywhere near it. Right? They were stuck with Siri. And so they have a bigger problem to solve, but they actually have better information than Amazon, because they know everything about, we were just talking before we got on about scheduling our next thing. And I'm going to be in one time zone, you're in another, and we're sitting there going, like, tearing our hair out, trying to figure out what's the common time that we'll have. And that's in your calendar, and knowledge of time zones and flights and stuff like that, all of which Amazon does not have, but Apple does. Google might, because it has Gmail and it has Google Calendar, and it has all this, but they're very disparate, and a lot of people don't trust Google to keep their information. So Google, if there's a kind of how close are they to the personal data, there's kind of number one is Apple, number two is Amazon, number three is Google, and OpenAI. What do they know?
Well, OpenAI knows a lot because they installed memory, and I love it because when they first installed memory, they were like, "Oh, here we're showing you every time the memory store is activated," and then a month later they don't do that anymore.
Now they allow you to opt in. They allow you to opt in. You can choose to have it. Remember.
Okay.
But the thing, my ChatGPT conversations are completely random all over the map. And I'm not asking them for personal data because I don't have it right there.
Yeah.
I'm asking them all kinds of random stuff, which they seem to know, and that's great. But their memory is going to not be a reflection of kind of my total personality. So, this is the thing, right? If you're going to have gems, you got to have all the gems that relate to you. And I wonder if Apple has noticed this guy at Amazon and is going like,
how do we buy? How do we get him?
Do it? Not try to get him, but just try to figure out how to do what he's doing.
So one kind of seed I want to plant in your head as well is that Amazon now has an incentive to go and this guy who appeared on this podcast, Amazon, I'm sure has very good relationships to the media and wants to push the fact that they're close to agents out into the public sphere. And so we should take advantage of that. Invite anybody from Amazon onto the show so that they can make their case clear.
I'd love to have that guy on the show because I'd like to understand where they are. And I think I mentioned this, but Amazon has not yet granted me the pleasure of using Alexa Plus. They've done it for millions. There are millions of people using Alexa Plus, and for some reason, I'm so not important anymore. I'm way down the stack. Like I keep asking Alexa, so when will I get Alexa Plus? She goes, oh, you're already signed up and you'll get it, when we
sometime.
decide.
Okay. So, oh man, so Amazon, that's great. I loved this insight into individual versus company. And now I want to talk about, because they also have AWS. So they also have a bunch of companies that they can go to once they figured out the individual, then apply it to the company because it's the same problem, right?
AWS is brilliant, by the way. I
Yeah.
mean, there's a whole sidetrack we could do because they're sitting there running Amazon's infrastructure, shipping, and it went from books to everything else, and it's the everything store. And so this guy who started AWS, whose name I can't remember right now, went to Bezos and said, we should start selling this to other people. That was Amazon Web
Yeah.
Services.
Yeah.
And
Yeah.
so when
Yeah.
Amazon Web Services started, they went after startups. They didn't go to big companies. But they designed this brilliant thing of like, okay, we'll give it to you, right? Startups, right? And they infect them. So they hit a couple of those really fast growing startups in the teams,
Yeah.
and they became big companies. And then they started using that to go to the big companies, and really remarkable one was they provide all of the cloud infrastructure for the CIA. So Amazon Web Service, they didn't fork it. They created its own instance that's entirely unplugged from the rest of the internet that the CIA uses to do its data. And AWS has many different applications. It started as data storage, and then it started as added compute, and then there's like 20 different pieces of AWS that represent the entire set of infrastructure that any one company needs to run on.
I got to ask the question because that sounds like a really interesting deal that I'm sure there's no public information on, but I really want to
No, there's
understand.
quite a lot because it is broken out. They do report it separately. They have to.
Okay, Amazon is a public company, so they need to report it.
Well, they don't. Nobody needs to do anything when you're a public company, but you have to meet the expectations of the analysts that evaluate the stock. So there's some compulsion. Like Apple has to break out its services business. They don't have to tell you which part is at Apple TV or something else, but they create they report their services revenue versus their hardware revenue versus and they report. I think they still report iPhone versus Mac, but how companies report is a function of what they're trying to communicate to Wall Street. So, and they change it from time to time. Netflix just stopped reporting on how many users they have. Which they've been reporting for 20 years.
And that's probably a bad sign.
Well, people could go either way, but the very first quarterly report they did after they stopped was a really good quarterly report. So like Wall Street has a very short memory, so they're going like, oh, this is okay.
Well, how interesting. How do companies do that? They have to be at a 1,000 to 5,000 person company probably when they go to public. That's a knowledge
companies don't go public before that. But it used to be that you could go public when you're a small company. Your Uncle Joe, for instance, his company went public in, let's see if I can remember this correctly, 1989, something like that, 87, somewhere in there. He went public.
Yeah.
He went public with like probably a couple hundred employees and maybe 80 million of revenue.
1991, NASDAQ initial IPO netting 18.1 million after expenses, $23 per share. The following year, they hit 100 million in revenue, delivering a compound annual growth rate of 54%.
Yeah, there you go. So you can't do that anymore. No companies go public at that level because there was a whole infrastructure for bringing companies public that was referred to as boutique investment banks, American Quest and several others. And then those investment banks got bought by the big banks, and so it all merged and kind of lost the edge on doing small IPOs. So a whole bunch of different factors. It's a different world now. You can't go public until you're big enough to handle the cost of going public, because the cost of going public is like 10x or 20x what it used to be, even in constant dollars. And and there's things like the CEO and the CFO will go to prison if they don't. If they lie. And so it used to be lying was part of the deal. But, They didn't think they were lying, but they were obfuscating. And so it's a much more tightly regulated and conservative thing. So you don't go public until you're big enough to have scale. So OpenAI could go public even though they're losing massive amounts of money. It's not just a matter of profitability, but there's this thing called the rule of 40, which rules our world. The rule of 40 is your EBITDA, the net profit in the business, and your growth rate have to total to more than 40.
Yeah.
So if you're growing 50% a year, you don't have to have EBITDA or 100% or whatever. But if you're growing less than 40%, you have to have enough EBITDA to get you over 40.
Beautiful.
And yeah, I mean, it's really functional. It works. It worked 30 years ago. It works now.
Wow. So that's the metric that no matter what's going on with the funny money economy and the quantitative easing and all this different stuff, that's the thing. Like, okay, you got to do this.
It's sort of like a stand-in for risk, right?
Yeah. Yeah. Okay.
You have the rule of, if you exceed the rule of 40, there's less risk in buying that stuff.
Yeah. Okay. Got it.
I'm trying to figure out. Valerie bought a Rivian. So I'm sitting there going, Rivian, look at Tesla. Tesla's, even though they've got all these problems, are still worth like I don't know, billions. I don't know. What is Tesla here? I can look it up real quickly. Stocks. TSLA. Oop, spelled LA. It's worth $1 trillion. All of the stuff that's been going on with Tesla, it's still worth $1 trillion, which is more than any other of the legacy car. Well, any of them. Right? So Tesla is still valued differently, and they make money, and you can apply that. But so the rule of 40 is kind of a proxy for how much risk is involved. So I've looked at Rivian, and I think Rivian's worth $8 billion. I can look at it quick because I'm following it now. Rivian. They're worth $16 billion. And Tesla's worth $1 trillion. So they go like, okay, well, Tesla makes some more cars. They operate all over the world. Rivian's in the U.S. is like 10% of their sales. But in terms of potential, you're going to bet on Tesla being worth more than $1 trillion 10 years from now, or you're going to bet on Rivian being worth more than $16 billion. We're in a whole different category now, but so we can go back to Cloudflare. And I looked up Cloudflare because I was interested in, and it's interesting, their trading symbol is NET. Yeah. It was really interesting how people choose their trading symbols because it kind of tells them what their expectations are. Cloudflare chose net when it went public. It's like the network, not just a cyber net company. They're currently valued at $72 billion. They're going to be worth $300 million, $1 billion at some point, or is it going to be $70 billion for the next 10 years, or plus or minus or less? So, when you look at when I look at stocks, I look at like venture capital. So I don't want to bet on the stock being worth 10% more 5 years from now. It's like whatever. I'll just go to Vanguard, which is where I put all my personal money because I don't want to take risk. Once I've got the money, I don't want to take any risk.
So let's dive into Cloudflare from there. Well, actually, sorry, wait. I've got maybe we can talk about this in another episode. But the Google those boutique businesses they were talking about, Google sidestepped them with doing a Dutch auction, right?
Oh God, that's an IPO thing. Dutch auctions don't really happen anymore. Kind of what took place at the Dutch auction thing was the whole SPAC thing.
Oh,
people want to go public with less hassle. They want to go public with less control that the company wants to, doesn't want the investment bankers to tell them what to do. So the Dutch auction was one way to go about that. It was like, and I barely remember what the whole thing was about. It was about how you price the initial
let's not go into that. That answered the question. Why? So let's go into Cloudflare. Let's go into agents. What is your evolving perspective of where Cloudflare? I read part of that article. What I really liked about the article was that this guy is really interested in the future of the open internet and wants to avert two of the scenarios. There's one scenario where essentially the how we know the internet right now is basically in for a massive shift because Google is the backbone of the internet, the financial internet, and they basically search and then pay content creators for their clicks. That's getting destroyed by AI. And so if that gets destroyed by AI, then AI becomes the only content creator, right? Like, well, no, what, like the whole internet dies, right? What goes on?
No, it's all about intermediaries, which is between you and it, them and us, however you want to put it. But they're always intermediaries. In my old business of magazines, we would sell subscriptions to people. That was a direct relationship to our readers. But most of our money came from advertising, and the agencies were the intermediaries. So there's always an intermediary. And part of the idea of the open internet is it would eliminate intermediaries and people would go direct, right? Publishers go direct to the anyway. Cloudflare is a really interesting thing because the comment he made in there was 80% of the AI companies depend on us. So they're a cybersecurity company, and they figured out a novel way of protecting companies from attacks in the cyber world. And but this is particularly relevant to AI companies because AI companies crawl other sites that crawl the rest of the web. And the statistic that was in there was they crawl them thousands of times a day. Any one site, right? New York Times or whatever, the AI companies are crawling that site thousands of times a day. And it may not be every AI company doing it, but all AI companies collectively are. And so you're sitting there as a publisher or whatever, you've got something, and they're like this flood of crawling going on. And so Cloudflare realized that it was in a particularly unique position because of the way that it protects enterprise domains to change that dynamic. And so they introduced this concept of pay by crawl by pay, whatever it was called. It's in the article. That if you want access, you got to pay for it. And they control that access, right? So they can share the revenue from that with the target, the destination that's being crawled, and it makes them an intermediary between the AI companies and the owners of content, which is a really interesting thing. And we talked to Bill Gross about Prorata. It's a much more direct way of monetizing crawling, and he's got kind of a by reference way of doing it, and so this is like the core of the issue. Like, where's the money going? Who gets the money? And if it only goes to the AI companies, then no one else has an economic interest. Then it disrupts the entire thing. And this is the sort of fundamental concern about AI: is the models, they go out there and they train the models by crawling everybody. And then build up the model, and then the chatbots can bypass the entire infrastructure. So, it's really hard to understand. And this guy, Michael Prince, is the CEO, founder of Cloudflare. This guy is like, phew. And this is why I like Crazy Stupid Tech. Fred Vogelstein did that interview with him. He was able to keep up with him. You could tell he was struggling during the interview to try to understand what the guy was talking about. This is like way out there on the edge. And this isn't like techno talk. This is how the business works.
Crazy Stupid Tech. We should reach out to him for an interview. Do you have a good?
Do you know Fred? I know Fred, and the other one is Ab Malik, and Fred and Ron together started this thing called Crazy Stupid Tech. But I'm not totally sure what the status of it is because hasn't been writing much. So it seems like Fred's writing the thing. I don't know. I'm going to find out about that. But yeah, I know Fred. Fred used to work at Fortune.
Okay, we should definitely interview him. Last 5 minutes or so, the Crazy Stupid Tech. It's funny. It's also called Crazy. Do you know about LLMs.txt? LLMs.text?
No.
So all website creators now can create a LLMs.text, which immediately routes to the LLM. so that you basically, as these barbarian LLM agents are scraping the entire web, you can make a peace treaty by telling them exactly what you want out of the, and there's all these indirect prompt injection. Speaking of which, let's talk about the security issue, because we're exiting the insecure world of web-based protocol networks, where if you put something on the internet, your social security number is getting leaked. Everything's getting leaked at some point. And we're exiting that world, and now we're entering a much, much more insecure world. Somebody has been using Claude to basically, they got access to ITAR data, which I've found out about ITAR from a whole other reason, which is the way that the U.S. government regulates the defense spending or defense specifications, all these different things. And so we're entering a really crazy world where all this stuff is going to become really insecure, and almost no one's paying attention to it.
International traffic and arms regulation.
Yeah.
I always look at acronyms because it tells you what that's about.
Yeah.
That started with arms regulations, but it applies to the entire world of national security. This is an American rule about whether you can export or not. So
they got the data set. Claude helped them crack the security defenses. They got the data set, and then they ransomed the ITAR people with $500K or something like that in order to pay it.
There's news recently that the Doge people put all or most of the Social Security data for the USA on an unsecure server. Can you imagine? The instant that happened, somebody went in there and got it.
Yeah.
And, that's our Social Security numbers and our earnings data. And, it's like, it's us.
It's a wild world. Okay, well, I think we can stop there. We'll pick up next time. Thank you guys for listening.